It's been in a corrective consolidation phase for a while now, and it might continue for some time. But I think the biggest catalyst to my mind more than anything else could be the result season, frankly. Because once there is confidence that earnings can come back and growth can come back in Q4, I think the markets can get back to the races. At least what I get to understand from the Q3 updates is that from a very challenging situation, you're getting to a little bit less challenging situation, right? So it's all about incremental improvement on a quarter-on-quarter basis. I think structurally still the lower end of the consumption trend is still quite soft. We may see improvement from absolute bottoms, and I think the stocks are also reflecting that because the stocks have not done anything for a long period of time. So sometimes more than the performance, it's actually what you deliver versus consensus expectations. So if the expectations are so low and you do slightly better, the stocks can do better, right? So I think again, like in financials, I think in the consumption basket, we still believe that the more discretionary, higher ticket consumption will probably do better, because there the consumer's balance sheet has generally been very healthy, right? I mean, a stock portfolio is up, his gold is up, real estate is up, and I think that that's where the momentum is. So whether it is premium real estate or otherwise, if you want to do lower end consumption, then I think you are better off buying the platforms, because they are aggregating demand across all segments and growing faster than, let's say, an individual FMCG company, right? I mean, a Marico or a Lever is still struggling to do single digit growth. The platforms are still delivering you 20, 25, 30% growth. And I think that's where the story is. I think capital markets is a far better place to be in on a structural basis, right? There could always be a few stocks that can be an exception to the rule, but I think non-lending financials is where I think the action is going to be. So wealth managers, brokers, asset managers, I think that's where money is going to be made on a structural basis, because it's very clear, right? I mean, if the depositor is moving from not putting deposits to doing SIPs, you better be on that side of the balance sheet. I think by and large, financials is still, more constrained by credit growth, right? The problem with the banks, as you can see from the HDFC update, is that while they've done very well on deposits, but they'd had to sacrifice advance growth, right? So I think, and that's the problem, that adjustment still continues where, everybody needs to shore up their deposit growth and moderate their advances growth. And we have seen a spike in unsecured lending. Obviously, MFI is at the extreme corner of that. But I think unsecured lending has, we've seen a little bit of a spike. So I think, this sector, the lending sector to me is likely to be, as a whole, very middling in its performance. There may be some standout performers. And I think Bajaj finally seems to be coming out of that kind of middling performance where, there was a lot of confidence that came back during the Bajaj Day that they did a couple of weeks back. And I think when the rest of the big banks are thinking of compounding or growing at 12 to 14 or 15, 16%, if Bajaj can grow at 25%, that's a great differential growth rate, right? So I think you'll have to pick and choose, but on the whole, I'm not very excited about lending as a space.
Not excited about lending.